Assertions are basically representations made by management. Assertions can be explained as declarations or strong statements or claims made by management which are interwoven in the financial statements itself. There are three categories of assertions, namely assertions relating to account balances, which are assets and liabilities, assertions relating to classes of transactions, for example, incomes and expenses, and lastly, assertions relating to presentation and disclosure. Here we will look at the assertions relating to account balances. There are four assertions relating to account balances. The first is existence. Existence basically asks the question, does the asset or liability actually exist? In other words, is it real and not fictitious? For example, when I worked at KPMG in South Africa, I audited a coal mining company. There was fraud discovered and the risk that fictitious trucks were included in the entity's fixed asset register was assessed as high. In order to address this risk, up to 60% of all the mining trucks had to be physically verified. The next assertion is called rights and obligations. This basically asks the question, does the entity have authority over the asset or a legal duty or obligation relating to the liability? For example, Entity X holds inventory items on consignment. While consignment stock is sold, it receives a commission on the sale. During the stock count, which assertion is most at risk? The assertion most at risk here would be rights and obligations. The goods held on consignment do not belong to Entity X and thus should not be counted as part of its inventory during the inventory count. However, if the consignment stock is not properly marked and separated from the other stock items, there is a risk that it would be counted and included as part of the entity's stock. Thus, the items would be included in the accounting records when Entity X does not in fact have the rights to those stock items. The third assertion is called completeness. This simply asks the question, is everything recorded? In other words, are there any omissions that should in fact be included in the financial statements? The fourth assertion is valuation and allocation. This asks the question, is the balance correctly measured and accurately calculated? For example, the accountant of Entity A was uncertain regarding the calculation for the allowance for doubtful debts. Discussions with management indicated that significant judgment was involved in arriving at this amount. What is the assertion most at risk? The assertion most at risk would be valuation and allocation. The judgment relating to the amount for the allowance for doubtful debts raises uncertainty as to whether the debtor's balance is correct or not. It does not affect the existence of those debtors or whether Entity A has rights over those debtors. Neither does it bring into question the completeness of debtors. To recap, there are three categories of assertions. In this clip, we looked at four assertions relating to account balances.